you really have to find value add properties. You have to find properties that have some distress on it, whether it's physical distress or what I would call financial distress, and have a way to fix it.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. Today I have Drew Kniffin. Drew, how are you doing today?
I'm great. How are you, Todd?
I am fantastic. Thanks for being on the show. A little bit about Drew. He has a corporate finance and real estate investing career that spans a decade. After finishing graduate school, Drew was an investment banker, providing valuation analysis and prepping small companies for refinance or sale events. From there, Drew worked at a Fortune 500 company in the Twin Cities, right by me, where he negotiated and implemented joint ventures in Asia, Central America, South America. Drew began his full-time real estate investing career in 2008, focusing on acquiring cash-flowing properties that maintain value through the economic cycle. In addition to being an investor, Drew has been featured on multiple podcasts, and also this one, of course, and also coaches aspiring multifamily investors. Today, Drew controls 1,500 units across the U.S. with a collective valuation in excess of $85 million. And you're in Seattle as well right now, no longer in Minnesota, which, we're sad about that, but Seattle's happy to have you.
I moved about 5 years ago, but it's been a good transition. I did enjoy my time in Minnesota. Although in January and February, sometimes you want to get out.
Yeah. So Drew, I got a question for you right off the bat. You, in your bio, you said you focus on acquiring cash flowing properties that maintain value through the economic cycle. Yeah. Explain that to me. What do you do? What are you looking for in properties, and how do you think they're going to maintain through the economic cycle?
Well, okay, so it's a great question. No one's actually ever asked me that question before, and I think it's the most meaningful sentence in that bio. So I think it's cool that you picked up on that. When you are doing the opposite, when you're buying properties for just appreciation based upon economic growth, you're taking a risk, in my opinion, and you're letting the control of the outcome be beyond you, right? So here's a good example of this. Let's say you buy a property for $1 million, and even after paying the mortgage, every month it kicks off $5,000 of cash into your pocket, right? And it does that, and it's well maintained, has a good reputation in the neighborhood. And so then let's say there's an economic downturn and cap rates go up, and all of a sudden on paper, your property is only worth $600,000, right? And you're like, oh shoot, I've quote unquote lost $400,000. But meanwhile, the place is full, the tenants are being care of, you're responding to work orders quickly. It's a quiet, safe, clean place for tenants to live. And every month it's putting $5,000 in your pocket. So that quote unquote loss of $400,000 is a mirage. It's not real. And it can withstand the economic cycles because it's cash flowing. Now, let's say in the alternative world, you buy $1 million property, but it doesn't cash flow. Its rents aren't sufficient, but you believe that rents are going to go up because it's in Manhattan or it's in Los Angeles or something like that, right? And lo and behold, the same recession comes along, and it barely pays its mortgage, or maybe every once in a while when there's large work orders, you got to write a check into the property, right? But you're like, oh, in a couple of years, it's going to double in value because it's in this growing market, but it's not cash flowing. So you're writing $1,000, $5,000, $10,000 checks into the property every month. And then on paper, it's gone from $1 million of value down to $600,000 because the cap rates have moved against you. Now, what's your conviction about writing that $5,000 check into the property to cover the mortgage every month when on paper you've lost $400,000? It's really hard to do. So that's the difference between those two models. And it's why I believe in trying to buy cash flowing properties, because it gives you the confidence that even when the value of the property goes up and down And it basically will, as markets get hot and cold, it's putting money in your pocket. And over time, the market will get rational and the property will go back up to worth $1 million or more as you're pushing the cash flow of the property.
Yeah, I mean, a couple of things on that. I mean, I can remember when I first started buying it, it was right during the recession, and my properties actually, I would buy them, and a year later, they were worth less than what they were when I first bought them. But I didn't care because of the cash flow.
Yep.
And I still remember people saying back in 2009, 2010. I remember sitting in a class. I was getting my real estate license. Because I was buying so many houses, I needed my license. And the instructor said something about houses. Eventually, every single house in America will be worth $1 million. And that's very forward thinking, because that might be a long, long time from now. But it probably will be, potentially will be true eventually.
Yeah.
And these people behind me were laughing, and they said, house values will never go back up to where they were in 2006. And a lot of people thought that. And then what you just said, where eventually your property will catch up. We've seen that happen.
Yep.
We just saw the worst real estate, recession probably potentially ever, if not, the Great Depression maybe. But now we see that values have exceeded previous values. So it eventually goes up, and the cash flow is huge. If you can withstand that, that's what's huge. I heard a lot of people that lost a lot of money that said I had a $50 million net worth back in 2006.
Yep.
And then they lost everything. Well, that $50 million net worth is just on paper. It's not paying the bills.
Right.
And
And so every single, now homes are a funny thing, homes that you live in, because they're not cash flowing assets, right?
Yeah.
So they sort of behave a little bit differently. But for rental properties, in the end, their valuation is always essentially a multiple of the cash flow.
Yeah.
So if you're producing the cash flow in the long term, it will get valued accordingly.
Yeah.
And so you just have to believe that and stick it out when it's tough, which is what you did.
Yeah. Yeah, no, good stuff. I really appreciate you explaining that. I think that's really, really important for our listeners to be thinking about that right now, especially in today's market. I'm assuming you're still looking at just cash flow and making sure you can force that appreciation through raising cash flow. Is that one of your main strategies, or what's the focus today?
Yeah, back in 2011 and 12, you could just buy properties that were cash flowing from day one, kind of like low hanging fruit. It was shooting fish from a barrel, and the word's gotten out. That's a pretty good strategy. And those deals, those properties are harder to find. So, I have a property down in Little Canada, Minnesota, that cash flows. It's a single family home, but it cash flows like $1,000 a month. Now, if I sold it today, then the buyer couldn't cash flow at $1,000 a month because the price has gone up so much. But it's because I bought it at that time, and I bought it with a little bit of distress on it. So your question is, nowadays, what are you looking for? And the answer is, you really have to find value add properties. You have to find properties that have some distress on it, whether it's physical distress or what I would call financial distress, and have a way to fix it, right? And so that it does require more execution to get to that cash flow today. It takes more execution now than it did before. So it's just, that's where we're at in the cycle.
Yeah. Explain to me like the property though, so our listeners can understand kind of what you're aiming at. I mean, are we aiming at a property that has 50% occupancy? What kind of?
Yeah. So there's, it can be an occupancy issue, or it can be just a tired seller issue. So, a property that you and I purchased together recently, the seller of it was essentially originally a lender into the property. And the person that owned it failed to perform well. And so the lender had to basically foreclose on the property, take ownership of it. But imagine Wells Fargo taking ownership of your home, right? Like, they're not in the business of owning homes. And so they wanted out, and they wanted out for a price that was relatively below market, but they didn't care because Wells Fargo didn't want to own the home. It wasn't really Wells Fargo. I'm just using this as an example. And so that was what I would call like a situational distress. It was someone that wanted to own the note on it, and they were forced to owning the asset themselves, and they wanted just to get out. And they didn't need top dollar. So we were able to come in and solve that problem for them. And also there's a lot of reputational challenge of the property. So we have to change the reputation of the property by taking care of the tenants, by fulfilling work orders, and getting good tenants in there, adding security, filling it up, improving the units. So those are some things that we're doing on that property together that are part of adding value. So it doesn't come where you can just buy a property that's kicking out a lot of cash and do nothing. After closing, you really have to have a plan that's been validated and then be able to execute on the plan over time.
And there's a perfect example of a property where, are we trying to create a lot of equity? Are we trying to increase the value of it? Absolutely. Mm-hmm. But it'll cash flow extremely well, especially when all the value adds implemented. And if a recession happens during the hold period, prior to a disposition, it'll still cash flow really, really well. Right. And so, like you said, it's really a non-issue if a recession does happen during that time. And that was one of the keys for that property is look at the cash flow. We like that. We can add value. We like that. It works, right?
Right.
It works all
right.
around. So.
Yep. You want to buy a property, you like to have your cake and eat it too, a property that has cash flow and has the ability to sort of push the value through improving the cash flow, improving the NOI, improving the rents. So you'd like to have both, but I just think, man, you're on thin ice if you're just hoping for, inorganic appreciation based upon a frothy market.
Yeah. You're continuing to hope for 8%, 9%. You're in Seattle. I mean, you guys have been seeing what, 9%, 8% rent growth for years. I don't know if you're still seeing that, but I know for a while you guys were.
Yeah, that's right. And so when you see that, right, like it's a herd mentality. Everybody starts saying, "Oh my gosh, I can't not make money, and I'll buy any asset at any price because it's going to go up." It's essentially you're playing hot potato.
Are you buying in Seattle?
I'm not. So I actually there's basically an outer suburb here where I did own 4 duplexes, and those have actually done really well. The rents, as you said, have been going up at like 10, 15% a year. And so the value of the properties have been phenomenal, but they've been duplexes. And so it just the amount of work and time that goes into it versus the value creation, I thought my time was better used elsewhere. And so I've sold those. And, by the way, Seattle, the city council of Seattle just last night passed an ordinance that you may no longer evict non-paying tenants during the winter months. And so it's a tough regulatory environment for it, and capital go where it's wanted. And, I was just emailing our attorney about an issue in the state of one of our properties, and the rules were just very friendly to landlords. And so I'm like, well, I think I'll put more of our capital there because it seems to be wanted there. And so, no, short answer is not in Seattle anymore.
And here's one thing, we can get political, which I don't want to, but,
right.
But one thing I'll say about the regulatory is in my opinion, you see it in markets that have massive rent growth.
Yeah.
So you see it in California. You're seeing it in Seattle. Seattle's had a decade worth of, rent growth that's really unsustainable. And finally, they're like, okay, this just is continuing. We have to do something about it.
Yeah, that's
We're
right.
going to slam these landlords. And we're starting to see it in Minnesota, in Minneapolis. And again, we can get political about it and talk about the blue states and the red states and blah, blah, blah. But one thing you've got to be careful in any market, if you're seeing massive, massive rent growth, no one understand that there is a possibility that you're going to see rent control if you're seeing unsustainable rent growth for too long.
Right. Yeah, no, I agree. And the reality is, of course, all things being equal, I'd rather have large rent growth, but the the most important thing as an investor is to have time on your side. Because if you just have 2%, 3% rent growth, but you have it over a 10, 15-year hold period on an asset, it's just phenomenal what assets, and then you multiply that rent growth times your cap rate, and we don't need to get into too much math. Just the returns are phenomenal. So you don't need to stretch for home runs. If you just have time on your side and you manage the asset well, we just have good fundamentals in this business, which is why you and I like it, and you'll do great.
Take me through the kind of that mindset shift. I mean, you were this corporate guy, right? You worked for a Fortune 500 company. You held various jobs, and all of a sudden, maybe not all of a sudden, I don't know how it happened. So I want you to take me through that. But then you start buying these rental properties, and eventually you quit your job and you're doing this real estate thing. So kind of take me through, I guess, maybe that growth period of, and also you started buying just small properties, if I'm right, single families and duplexes and stuff like that. And to now you're buying larger properties.
It was an aha moment. And then an aha moment where I basically decided to dump jet fuel on that aha, right? So when my wife and I first got married, we bought a condo down near the University of Minnesota, and we bought it for, $260,000. And then the Great Recession happened, and we wanted to move out of it to move closer to where she was working. And so the option was either to sell it or to rent it out. And I wasn't like thinking mathematically. It was just those kind of your two binary options. And we were underwater on our mortgage. And so we're like, let's just rent it out. Not thinking too much about it. But we put a tenant in there, and lo and behold, over the next year or 2 or 3 years, a couple of things were happening. The tenant was paying down the mortgage. The tenant was putting a little bit of cash in my pocket, and the market was normalizing, right? And so the value of the property was going up because properties were going back up in value over time. And so what I noticed was I could have sold it at that point in time and written like a $30,000 check at closing into the property to enable it to close and pay off the mortgage.
Yeah.
Or I could rent it out. And what happened was, as I rented it out, the mortgage went down, the value went up, and it was putting cash in my pocket. And a couple years later, I did in fact sell it. And the price had gone back up to what we bought it for. And the mortgage had gone down by like $50,000. So instead of writing a $30,000 check, when I sold it, I got a $70,000 check to me. So it was a $100,000 delta, because I didn't do anything. I just like rented it out to a nice tenant who took great care of it. And so that was, in a sense, my aha moment. It was like, wow, this is a really cool space. And I said, well, if I can do this with one property, what if I could do it with 100? How can I scale this? How can it grow bigger? And then you just kind of pull at that thread. And then it's usually people find that it's pretty hard to scale single family homes for financing reasons and logistics and management. And so then you're like, well, I like this space, but single family homes aren't the answer. What's the answer? And then you move toward apartment buildings or maybe self-storage or something along those lines. And so that was my story. And there's a lot of nuances in there, but it was that story. And I was like, this is amazing. Like, I basically improved my net worth by $100,000 by making one decision and then just adding time to the equation. And over time, it's the phenomenal asset to be in. So essentially that's it.
Yeah. Cool. And so once you transitioned, once you said, hey, I'm going to start buying these bigger properties, what was your first big property?
It was a 32 unit in St. Paul.
Cool.
And
do you still own it?
It just sold last month. But what we did is we bought a triplex from a wholesaler, all cash. We put in $20,000 into that property, filled it all up, and then we got it appraised and put a mortgage on it and pulled out a whole bunch of cash. Yeah. And with that cash, the timing worked out right that we just took that cash and put it as a down payment on the 32.
Oh, that's awesome.
So all that happened in like 3 months. And what was amazing, Todd, this is one of those aha moments where you realize, ironically, going bigger can sometimes be easier. is that the financing and the work and the logistics for like closing on the 32 was less of a headache than getting the financing for the triplex.
Yeah.
And you're just like, wait, I just bought a 32 unit. So I literally 10x the number of units, and it was less work. That seemed too good to be true, but it was true. And so then you're like, well, this triplex stuff, is not where I should be spending my time. And so that was another aha moment that took me not just into the owning rental property space, but the larger rental property space.
I can still remember I had a property that I bought for dirt cheap and didn't stick much money into it. It just didn't need that much work. And it ended up, it was worth about $110,000 at the time, but I didn't want to put that big of a loan on it. Honestly, I just wanted to have really good cash flow. So I wanted to put a loan on it for about $50K, which would have still, that was going to bring back about $20K into my pocket. That's all I was in it. I couldn't get a loan for $50K. Nobody wanted to give me a loan for $50K.
What year was this?
This was back in probably 2012. But it wasn't because of that. People were willing to give me a loan for $150K, $250K, $500K.
Right.
But $50K they saw as a high risk loan that just wasn't worth their time either. Oh, I'm like, oh, what? Whoa, it's easier for me to get a loan on a 20 unit building than it is for a single family house that cash flows, $800 a month, but it's only a $50,000 loan. They don't want to deal with it.
Yeah.
So that's funny. So when did you kind of stop? When did you make this real estate thing your deal? When was it?
Yeah, so it was a side hustle for a while during the Fortune 500 job, and it was cool.
Yeah.
Got a couple rental properties, and it was fun. And it's kind of like some guys like fantasy football, and I liked this. So I would geek out on this instead of talking about who the the Oakland Raiders wide receiver is.
Yeah.
And so I was just scaling it up, and then it got busy, right? Then it got busy, and you're like, okay, it's starting to produce a little bit more cash. I can see where this is going. It wasn't enough cash to just live off of at that point in time, but I could see where it was going. And, my spouse has an income stream too, so that helped ease the transition.
Yeah.
But it was too much time to do the W-2 job and run the real estate portfolio and live a life with friends and family. So something had to give, and I just made the leap. I just said, the W-2 job, I ended that and went into this. And it took a while for this to grow, right? I didn't like, honestly, for the first year or two after I quit, I was working like, 15 hours a week. And I was like, I don't know what to do with the other 25 hours. So I spent a lot more time like working out and with friends and family. And then eventually this has grown, and it does take up a lot of time now. But it was not enough time to do the regular job and then this and then still have a life. And so you just had to make a decision, and that's the decision I made.
You did some multifamily coaching and you're around a lot of people you're seeing have success. And you've had your success. So between others that you're around, between others that you mentor, what are some, let's go with 3 key things you see that takes people from, or that maybe separates those who have success from those who don't have success?
Good question, Todd. So my first thought is persistence. And this is something you've heard from people before, but you hear it because it's true. So my first ever coaching student, we went through a year together of coaching, and we looked at deals, we put in offers, and we got close on some, and we never got a deal done together. And then his year ended, and we stayed in contact over texts and Facebook, and I saw what he was up to. And it's probably been about 12 months since we finished together, but he stuck at it. And I just saw the other day that he closed on a 48 unit in Lexington, Kentucky. And so he's on the board. And I know based upon his personality and his hunger that he's going to, make it work, and that this will be the first of many for him. So, and in contrast, I've seen some people not persist, sort of follow the next shiny object, and they get involved in a different industry or a different space or a different course, and they bounce around. So, but he stayed focused there. And so I take persistence.
Yeah, that's huge.
Another one for me is partnering, right? So the more I'm around this space, the more I see almost no one do a deal by themselves. Like not even half the time, like almost never. You always end up with someone else who's better at finding the deal, better at underwriting the deal, better at raising the capital, enjoys the post-close asset management more. And so it's just a team sport, right? It's like you can't play football by yourself. And the more I'm around it, turns out to be that way.
And there seems to be, it's just more successful too, because it's so hard to be everybody and have your hat on and try to be this person and that person and the other. And if you could just partner with people, find the right people, it just seems like that the success, you're going, oh man, but I got to give something up. But guess what? You now are more profitable and you're able to do more deals.
Right. It is, I think, whatever, 50% of a big deal is much more than 100% of a small deal, 100% of no deal. But I think, starting out and just human nature, you want to have the whole pie for yourself. Yeah. And I think there's something refined or something that we all go through over time where we just kind of settle on like, you know what? If I do 30% of this deal, I get 20% of the GP, but I'm with 5 other really smart guys or gals, like that's a great thing. And also they keep you accountable. Like if I'm going to go on vacation for a week, I know that you got my back and you'll take the emails. So, or you'll keep me on my toes. If I'm not watching the numbers, you'll look over this and say, why is this number down? And so it's preferred. It's how it almost always happens.
For sure.
And then the third thing is having some geographic focus. I know in my own story and in some of my students, they're like, oh, there's no deals in Sacramento, California. So then they bounce over to Vegas. And then 2 months later, there's no deals in Vegas. So I'm going to go check out Reno. There's no deals in Reno. It's like, well, there's probably a deal in Reno somewhere. Maybe you got to dig harder. And so having some sort of geographic discipline is really important too. So we can't know all markets.
Yeah, and I've seen that too with myself. I first started like going, hey, I'm going to do multifamily real estate, and I decided to. Minnesota wasn't maybe the place I was finding any deals, so I went and bounced to all these markets, and I'm looking at all these markets, seeing these good deals in Montgomery and in Cleveland and Phoenix, and I wanted to buy them all, but I had to realize that look, I'm going to buy nothing if I'm going to look at everything.
Or you're going to buy them and not execute on them well because you're trying to be in Cincinnati and Birmingham.
Yep. And it's not going to happen. And the only way to even kind of do that is to partner with the right people. And so that can be a way to successfully be in different markets, but you can't be doing it on your own, especially. So let's shift to mistakes you've made. I'm sure you've made one or two. I just want to know about one, but what I want to know is a mistake that you've made. And more importantly, I want to know, what did you learn from it?
A mistake I made was recently in about the last 12 months, was letting earnest money go hard on a deal that wasn't all buttoned up. So we let, what's the amount of money is a meaningful amount of money that really hurt to lose. And that's different for everyone, but we put a lot of earnest money down. We believed that we had a clear path to closing this deal. We were told that our money was waiting for us. And then after the earnest money went hard, our equity partner basically said, you know what, we don't like that market so much and we're feeling different and we'll get out. We're out of here. And on this one deal, we were trying to work with one equity partner. So that partner held all the leverage, right? And all your eggs were in that basket. And when they went out, our earnest money went south, not theirs. So there's a lot of, maybe there's 2 lessons in there. There's probably a lot, but 2 of them would be, think about alignment all the time. So when my earnest money is hard, but that guy is bringing the equity to close or not close the deal, that's misalignment.
Yeah.
Right. They should have their earnest money locked up in it if they're the ones that control whether we close. So that was a tough lesson. The other one is choose your partners well. So that partner turned out to be, they flaked out, right? And actually the answers they gave were factually wrong. They were saying, well, this market doesn't have growth. This market, the rent comps aren't good. And we could just factually show, no, what you're saying is not true. But I don't know, maybe it was a smoke screen. We never really understood it fully. But what I also learned there on the positive side was the partners that I was working on in the deal were good guys, right? Because after the deal went south, that's usually when people start pointing fingers and, it's your fault, or you did this wrong, or you didn't, tie this down. And we all just kind of took the hit and have continued to work together and build off that difficult experience, but it built some rapport and trust. So that was a really tough experience recently.
So I don't need to know the market or anything like that, but have you been able to, like, the relationship with that broker? You always worry about, if something like that happens, that relationship with that broker is completely done and gone. Is that the case, or have you been able to salvage a relationship and potentially be able to do business there again?
Yeah, it's been wounded. I don't think that we're getting sort of the pocket listings that we would have otherwise. I think we tried to be straightforward with regard to what the situation was and why we weren't able to close it. But yeah, it's a hurt relationship, right? Because the deal was under contract for a long time, and so the emails were like, "Hey, you guys on track to close?" And we said, "Yeah, we believe we're still about to close." And then ultimately, when we didn't, everyone goes back to square one. And so yeah, it's a difficult relationship. It's a damaged relationship.
Yeah. I think communication in that type of situation is really important too. Recently I had a conversation with one of my friends who, the transaction ended up going through, but there was just no communication on the buyer's part. And that actually damaged the relationship between the broker and, my friend who was the seller, and a lot of people involved don't want to do business with this other person. Because there was zero communication. And so you guys communicating and being open and honest, and that definitely helps, at least. Now, obviously you didn't execute, so you probably damaged the relationship, but still, as long as you're open and communicated, that probably helps.
There's always two things. There's, like, listen, as syndicators, there's two things we can do: perform well and communicate well.
Yep.
Right? For your property manager, your property manager has two things they can do. They can perform well or communicate well. And the killer is when both of them don't happen. So if we as syndicators are working on a deal and it's not going too well, that's tough. But if we also under communicate, that's a killer.
That's a killer.
And so, we have an inclination to want to not communicate bad information or the tough information, but that's an instinct we all need to be fighting.
Yep. And telling them on the solutions, like, what are we trying to do? How are we working through this? And that's really important. So understanding that, look, there's tough things happen. Like, I've got a property right now that's we're behind on our performance. We would like to be at one spot and we're down here. And I'm trying to be open with the investors and tell them exactly where we're at. I'm still very optimistic about the property. I still think it's going to perform extremely well, but at the same time, we're not hitting our mark today. And we're just trying to communicate well with them about everything that's going on in the property and where we think we're at and where the trend lines are going. And that's really important. That's going to, in my opinion, help me and everybody else out in the end, where they're going to go, okay, at least we understand what's going on. We're not pissed off. We're not like wondering, always questioning what's going on.
Yeah. So. Yeah. I spoke about alignment before with your equity investors, and on a typical syndication, one thing that we like to do is put in our own money. So, I always tell my investors, listen, I put in $50,000 myself, or whatever. Or we as the GP have put in $100,000 ourselves. So, we are in the same boat as you, and I think that will, people respect that and they understand that. And 100%. We always try to do that as an organization. It's one of our, values.
So, Drew, where do you visioning yourself 5-10 years from now? Where do you want to start or continue to move the business? What are you looking long term?
It's a great question. We try not to get too wrapped up in visions that are too far out, because so much happens between now and there. I mean, 5 years ago, I thought buying 3-bedroom single family homes was
the best thing.
big hairy stuff, right?
Yeah,
So
yeah.
with that caveat, right, we do want to move toward a portfolio of 5,000 units in 5 years and 10,000 units in 10 years. I think that as we get systematically larger, we can have better systems and better personnel and get a little bit more vertical integration and control of our portfolio as well. It really stinks to outsource to third parties critical functions. So what are the most important things, and what are things that we can sort of control our own destiny for, or something that we talk about a lot. Timeline for that stuff is very up in the air, situationally dependent, but it's something that we talk about a lot.
Yeah. Yeah, that's very, very powerful, and something that I really want my listeners to understand is what you just said there is really trying to bring, you guys are talking about bringing things back into the company that are third party, being able to control that, making sure that you're vertically integrating your company, building systems and processes, and there's timing behind it. You can't just create your own property management company with 200 units. It doesn't make sense, but there's time behind it. There's timing behind it. And if you're working on it right now today, it's going to be easier to make that shift when the timing does make sense to do.
Right.
So,
right. Yeah. I was speaking to our asset manager recently. He I forget the exact situation, but he basically said, if this property manager or this, on-site manager worked for me, I could tell them, please do X, Y, or Z. But when I'm their allegiance, their reporting is first and foremost to their regional within their property management company. And we can sort of pull on a string, but it's more indirect.
Yeah.
And it's tough, right? Because sometimes you want to make things happen more quickly or follow a system. And so those are things you see over time, and you just naturally see opportunities to take control better. So that's a big thing for us.
Yeah, definitely. No, I couldn't agree more. Couple last questions for you before we wrap up. What's a favorite book you can recommend to our listeners? Business, real estate, whatever.
Well, the one that first gave me the vision was The Millionaire Real Estate Investor by Gary Keller.
Yep.
And I think that was very early on when I had like 1 or 2 single family homes. And it just kind of laid out the vision of how people, I think it had a lot of biographies or a lot of cutouts with actual stories of individuals where someone started with a single family home and then a triplex, and then they grew the snowball. So that one was, I read that a long time ago. I haven't picked it up since, maybe a couple of years. But that one, it made me go from other people can do this to I can do this.
Yeah. Cool. Last question before we wrap up. What are your 3 pillars of wealth creation?
3 pillars of wealth creation. So, I think the one key ingredient, I'm not sure if this is, what you're asking about, but it's time, right? If you have time, everything is your friend. If you don't, it's going to be really hard.
Yeah.
I would say another thing is don't be too greedy. Like a 12% IRR over time will just do wonders for you, right? We'd like to do better, but if you're, I know people that were trying to double their money in Bitcoin and this kind of that, and to me, it's just like just playing with fire, and you don't have to build wealth over time. And then thirdly, I would just say, be cautious about investing in companies or industries where there is creative destruction, right? So just in the last 24 hours, I learned that, what was it? One of the big leasing sites, like the apartments.com, got bought out by CoStar, right? And so I was emailing some people about that, and basically the answer is these internet listing services built their business model on good Google ads and Google keywords, right? And then the industry shifted, and these people are now getting leads by social media, right? And so creative destruction really imploded their business model. right? One of the things that I love personally about apartment building is really hard to imagine technology or some sort of new industry making apartment buildings unnecessary. I've thought about that. Maybe I'm not creative enough, but I can't think of a way that we won't need apartment buildings in the long term. And so unlike investing in General Motors, where Tesla upends them with electric cars or something like that, I just think that we have a pretty good chance of always needing apartment buildings. Now, what they'll look like might change a little bit, but fundamentally, it seems like a class that is resistant to other, industries coming in and upsetting our invested dollars.
Yeah. So invest in sustainable industries. And I think that's very sound. I mean, if you're looking at it as a long-term, a long-term investment, investing in something that's sustainable, that's something that's not going to have major disruption, could be extremely valuable.
Yeah. I mean, we syndicate on 5-year terms, but personally, if you and I buy a deal together, my vision is let's hold it for 20, 30 years. If it's a great asset, why are we interested in selling it? Maybe I'm going to refinance it or pull out some cash, but I love owning these assets for the long, long, long term.
Yeah, definitely. Drew, how can listeners get in touch with you?
Yeah, they can reach out to me. My email address is drew@nighthawkequity.com. So Nighthawk without a K. So it's NIGHT Hawk. And would love to just chat and maybe talk about pointers. Be happy to speak with anyone.
Awesome. Well, definitely appreciate it. A ton of value you're able to add to the show. So appreciate that. And you have a fantastic rest of the day.
You too. Thanks so much, Todd. Good talking to you.
Good talking to you. Hey, definitely appreciate Andrew Kniffin for joining us on the show, and tons of value he was able to provide us. A couple things I took from this episode. First of all, one, don't be too greedy, right? There's always more deals around. And we want to be able to share our results, our profits. And so don't be too greedy. Next thing is he talks about persistence. And I think he nailed that story with the student that he had success with. It was after 12 months worth of coaching. And even after that, just continuing to be persistent, there's finally results. And then the last thing is he talks a lot about asset management and how important it is and how that should be a focus on your business. If you're a business owner, a real estate investor, asset management is definitely going to be a big focus if you want to be successful. So again, appreciate Andrew joining us. A ton of great value. Go back, rewind it, re-listen, take one thing out of this episode and apply it to your business this week. And look, getting better one day, one step at a time is going to compound us to being amazing, to getting awesome results. I'm Todd Dexheimer. I'm signing out. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.